into by private equity, we started buying back a lot of our franchisees and then also rolling up property management companies around the country. And so since beginning of 2016, we grew to about 23,000 single family homes under management, managing those for 14.
So you guys have managed over 23,000 properties?
Yes.
Wow. Okay.
And we're doing that for 14,000 investors. So it's not like we're just managing for these large institutional funds, although we do work with the larger funds. It's a lot of one-off owners, which when you look at the single-family rental landscape of 1 to 4 units, there's about 22 million 1 to 4 unit single-family homes, and most of them are owned by people who own less than 5.
Got it.
So we realized that a lot of our investors, our owners that we manage for, were selling or buying. And we were not capturing that business. So we went out and we found a great online marketplace called ownamerica.com. We acquired that company along with its management team, a great team of people. And we did that at the end of last year. And so then in March of this year, we rolled out our platform.
Got it.
That platform, we have about, just since March, about close to 1,000 listings on there, most of them all exclusive.
And these are not MLS listings, these are pretty,
some get put on the MLS by us if the owner says, hey, because sometimes, it might be a property that might work better for a homeowner, it might work better for an investor, it might be good for both. So if the owner would like us to, we'll put it on the MLS, but we control that.
Got it.
So there are exclusive listings. They're not daisy chain. They're not, they're not from somebody who knew somebody and we're just putting it on there. They're all people that we vet, all properties that we vet that we think are sellable.
Got it.
So we started out.
Let me ask you this. So for, the person watching a lot of times will have somebody like you, a lot of the people we get. I mean, Chicago Re has over, 6,000 people, right? And most of them, they're not institutions. These are individual investors. And we have about, 500-600 people that have over 5,000 to 6,000 rental properties. That's 10, 12 rental properties each person, not counting mine, not counting Rahul's, right? And so these are very productive people, perfect people for you guys. And a lot of times, the people that are your perfect clients, right, are the ones that have done well, but they're like, man, why would I want to use a management company? What is the advantage to that? And that is a question. In fact, when I had 2 or 3 properties, I used to think the exact same way. Now, I'm like, no, I should have used a management company from the beginning. So explain why people come to people like you guys. What's the advantage of it?
Well, so I think it's important when you first start investing to understand how to manage a property, because then you understand what the property manager is doing. Because sometimes people think, oh, well, it's easy, give it to a property manager and it just gets managed. It's a collaboration between the owner and management company. And if you want to get to scale, if you want to defer risk, if you want to be more efficient and spend more of your time finding the deal and getting the property rather than, it's kind of like working in your business or working on your business.
Right.
So if you want to work on your business, if you find a good property management company and leverage their expertise and scale. So for us, a lot of people say, well, in Chicago, we manage 600 homes or so. What does that mean? Why does it matter if you manage 23,000? It's because we've created scale, and with that scale, we create efficiencies. And with those efficiencies, that rolls into the ROI of the investor. So things like how quickly you lease a property, how quickly you respond to a repair or maintenance is a direct correlation to your tenant retention, for example.
Got it. So a lot of times what people think is, well, I'm an individual owner, right? And think about it, if it's you, that what happens is you're like, well, I'm thinking that I'm going to save every penny. And we all start out that way. There's nothing wrong with that way of thinking. Yet if you want to scale, what's going to happen is how you manage 2 properties versus how you manage 10 versus how you manage 20, 30, 40, or 50, right? Things will change, and people like you guys, right? There's a lot of companies, but you guys happen to be one of the biggest one of them, right? Somebody like Renters Warehouse can add that professionalism and free you up for tasks, which is what you said, is working on your business rather than inside of your business. And these are 2 completely different mindsets. And believe me, I'm the first one to admit that a lot of times whenever entrepreneurs, when you're kind of new in the business, you want to hold on to as much as possible. And what you realize is that you only have to hold on to the key things and let the rest of it go for you to grow.
Absolutely, and just because you have a property manager doesn't mean you step away from everything that has to do with the property. You still have to make decisions, and it's a matter of, especially, I ask this question for a lot of people, is that when they say, well, I manage it myself, I go, well, how much does it cost you per door to manage? And they're like, well, nothing. I'm like, no, that's not true, because you're spending a lot of your time, and especially if you're an aspiring investor or you're just starting out, you have a job, you have different things, and if your goal is to get out of your job and invest full time, you still want to leverage a professional property manager, and it's just a matter of being more efficient.
Makes sense. So let's talk about like kind of a little bit background, because I think a little bit background of where you come from and how you came to this will help a lot of our audience. And then I want to kind of get into what type of marketplaces are good to invest today, because that's always a fun discussion. So where do you come from? How did you end up here?
So I don't currently reside in Colorado. I mean, in Chicago, but I live in Colorado now. I started out in Chicago in commercial real estate. I got into, before the downturn, I got into real estate investing, kind of when everybody was going crazy with that. After the downturn, I really dove into real estate investing. I was buying 2 and 3 flat buildings, doing hard money loans, refinancing them into Fannie Freddie. When the institutional funds started to come in, I had a team, and we were buying homes for guys like Invitation Homes, Waypoint, things like that. And then that grew into, because they didn't buy every deal.
So you were representing them on the brokerage side?
Yes.
So Rosario, our friend,
was my competitor.
Yeah, was your biggest competitor,
oh yeah,
right?
we were
neck to neck all the time, right?
competitors.
Yeah.
And so we were sending a lot of deals to likes of Invitation Homes, and they would turn down 75% of what we sent them. And so if we started packaging those up and sending them to smaller investors, and that's how we really grew that, and did close to 3,000 transactions in a couple of years. Worked with guys like Frank Montreux, worked with all kinds of investors, and really grew that business. And that's how I got my feet wet. And talk about when they say the 1,000 hours to get into something. I mean, I accelerated that in a couple of years because we did thousands of transactions, and I've then parlayed that into the real estate industry overall and the single-family rental industry. As it's being institutionalized, there's a need for higher level of service, and that's where Renters Warehouse came in. And but even before that, I was working with investors all over the country and helping them find and grow their portfolio and consulting with them. And now, as the real estate industry is being disrupted on just the regular retail brokerage side, it's also being disrupted on the investor side. I mean, there's a million investor transactions a year, and you've
hold on. There's a million investor transactions a year, right? For everybody that's a loan officer, for everybody that is a real estate agent, a service provider in the real estate space. This is something that I have been talking about all the time. In Chicago, 29% of all transactions are real estate investors. They're not your mom and pops buying a property to live in. And this is something that is severely being ignored by our industry.
It's being underserved, and we see it where you have all of these real estate firms fighting over that. You've got 1,000 people fighting over a small or a large part of the business, and you have maybe 5% of the agents and brokers focusing on the investor space, which is 30% of the market here in Chicago and 20% nationally.
Right.
And so we saw that opportunity to really step in, and along with a couple other companies, we're not the only ones doing it, that are really raising the bar. And so what that means is the property managers who are kind of just sliding by, they're getting pushed out a little bit, and there's technology, and there's less friction in a real estate transaction. So now you can go and, I was using this example earlier, we've got investors in Seattle where the market is crazy that are buying in Chicago or buying in St. Louis or buying anywhere.
So hold on, because that kind of leads me to another thing, right? Because for a lot of people, right, you have properties, your portfolio, 5, 6, 8 properties, let's say, right? And you guys are doing property management. How does that work, let's say, for an investor, right? That's your client, and let's say they have 10 properties. They have 10 properties in Chicago for sale. And man, in our market, there's a lot of mid-sector markets here. And what you can almost get close to retail price from an out-of-town investor rather than selling it locally to a Chicago investor. Would that be a fair statement?
Very much a fair statement. And so where we saw the opportunity with our marketplace is that you can sell properties in Chicago to people all over the country. So we have investors and buyers, whether they're on a large scale or a small scale, that are looking all over the country. And so when somebody comes to me and says, well, what's the next market do I need to go into? I say, well, we have 41 that you can choose from, and you can buy one house in each market if you wanted. And so And also another thing, so you mentioned that as far as the fair market value, these aren't, this isn't, we're not in the world of discounted wholesale. I mean, there are the wholesale market, and all that is alive and well, and it always will be. But what we have on our marketplace are homes being sold at fair market value that have a good yield, that are
performing properties,
performing assets. And so, and you're exactly right. An investor in Seattle or California is going to look at a $120,000 single family home that performs at an 8 cap as a great investment, and they can buy 5 of those for what they can buy one. Or 1.5. So it's that's what's interesting.
I want to talk, you guys are in a lot of markets, right? You're running around the country talking to a lot of investors, a lot of people, a lot of influencers in the community. In terms of markets, let's talk about, because this discussion we had, and I'm like, man, we got to talk about this, right? Because this is being missed, which is the big markets versus, to me, kind of the mid-market, right? And you made another statement about number of properties owned as rental properties in rural America. Right?
Yeah.
So I want to kind of take those one at a time.
Sure.
So can you break down, as you see it, how do these marketplaces break down? So in terms of size, in terms of population?
Well, so the institutional investors came in and they started buying in the top 13 markets.
So the Chicago's of the world.
The Chicago's, the Phoenix's, the Vegas's, the Denver's, Tampa, Orlando, all of Florida, Kansas City, St. Louis, even though some of those are still great investor markets, Dallas, Houston. So, they really went big in these markets for a lot of reasons. They were buying at the bottom of the market. There's a lot of upside. There's a lot of opportunity on the HPA, the home price appreciation. Now,
and they can build huge scales.
And they could get scale, which is really important to them, because companies like ourselves, while we were around, we weren't at the scale we were at.
Sure.
So, we're centrally managed and things like that. So now the opportunities, well, and so as we talked about before, what happened was a lot of these bigger metropolitan areas, they're still having some issues as far as the infrastructure of the areas where there's high taxes, there's issues with the pensions, there's all kinds of problems. A lot of these smaller markets really open themselves up for business. You have a ton of business, healthcare, manufacturing, all kinds of different businesses moving into these smaller markets, which I would say mid-sized markets, top 100, but not top 25.
Sure.
And they've opened themselves up for business. There's low taxes, a lot of millennials moving there, a ton of opportunity, and therefore a ton of opportunity for investors to come in, because look, 40% or so of the single-family housing stock are rental properties. Right. You have an affordable.
So hold on, man. You make these points and then you run through them.
Yeah,
right?
Sorry about that.
So hold on, because that's an important point, and I want people to get it. Which is what he said is 40% of all stock in single-family properties are rentals. Right, a lot of people, and this is something that is always kind of puts a smile on my face. Right, Yahoo News or any of these financial news. Millennials don't want to buy properties. They just want to rent. I mean, and I'm happy. Every time I hear that, I get excited, because I'm like, fantastic. Who cares? They'll make great, tenants for our properties. Absolutely. We're happy with that. We have no issue, because every time that there is a, upside to something, there's a downside to something, there's always an upside. And the more the bad news, the more money you can make.
Well,
right?
in the sensationalism in the press talking about the housing market, and I posted a ton about this online in the past. A lot of it has been hype, and we have to, in housing, you can look at history and you can see where housing prices have always done this. They've rarely gone down. They fluctuate a little bit, and there's seasonality and things like that. And there's a new normal. There is affordability issue, which is is what it is.
See, I don't know if it's a new normal. I think if you look at the history of this country, right? To me, it starts after the 30s, right? Then it goes into the 40s was kind of blah. Then it's the 50s. Then it's the 60s. We all have nostalgic things. People are like, well, you don't know, Andrew, how it used to be. The guys, listen, I know how it used to be. Most people used to live in a house the size of a postage stamp, right? They used to have one car if they could afford one, right? They didn't have any luxury. Today, drinking a $5 cup of coffee is not considered luxury. That's considered a necessity to wake up.
Well, most people put 50% down on their home, and there's a lot of things that drove up prices, right?
There's a lot of things that people sacrificed that today we consider our basic necessities. To me, if you really understand history, we're in a market that is better than it's ever been. Now, it looks different. Just because it looks different, we have this nostalgic notions of, oh my God, when the West was discovered. Guys, listen, life is better today when it comes to, at least from an investing perspective. Now, do we have challenges? Sure. But we all like to bitch and moan, right?
Yes.
But I mean, truly, there's more opportunity today than there has ever been. And it's going to continue that way because that's called the progress. I mean, that's just how, that's what I kind of believe in. So about 45% of the market is investor marketplace, right, today. And you also have made another statement that 55% of rental properties are in rural areas.
Yeah, so there's a study that was done recently, and we can find it when we post this and link to it. About 55% of the single-family rentals are in rural areas. Now, you can start to segment those. In some of these rural areas, you're talking about low value assets that probably aren't that much of an opportunity for an investor coming from where we're talking about, but it's a very good local opportunity. Absolutely. And those are a lot of people rent. And whether it's because of affordability or mobility, I mean, we've started to look at our base, and we have a lot of tenants who rent but own investment properties. Right. And the reason, this is my theory on this, is that, let's say you can pay $2,500 a month in rent. The home you want to buy is a $5,000 a month mortgage. Right. So you rent that $2,500 a month home. The barrier to get into a house to buy as an investment is much lower than the barrier to buy the home you want. Correct. So why leverage yourself to the tilt to barely make it to the home you want? Invest into properties, get yourself to a point where you can buy the home you want and not have to have it fully over leveraged and all of those things. And so that's the path. I mean, just because you rent doesn't mean you can't invest.
No, and this is kind of weird that I'm saying this of all people, because I tend to be extremely conservative in a lot of things. But in fact, lately I thought about this, right? Because typically I'm not going to buy a house just to buy a house. That's just not, I'm not built that way, right? But I have no problem, right, paying $2,000, $3,000 in rent. Now the problem is this, that property will never cash flow. So the owner who actually owns the property, it does not cash flow for him. Now they justify, they're like, well, Andrew, you don't understand. I bought it for $350,000, $400,000, and I put $150,000 down, right? And I'm like, guys, listen, that's not good cash flow. Right? It's great for me. It's like same thing. The other day we went down to Smokies, right? We rented this massive house, $1 million or so for 3-4 days. Right? Man, a night we're paying $400-500 a night. It was beautiful. It was better than the best hotel we could ever had. We had a bowl, and it was, you use it. You're like, thank you very much. We really appreciate it, and we leave. And really, that's the society we live in. And yet we see that all the time in Chicago nowadays with people that live in Chicago, and they're like, man, we want to have flexibility, we want to have mobility. And I'm like, what does that mean? Flexibility, mobility, which is all they're saying is, I want to be able to do what the hell I want to be able to do when I want to be able to do it. Right? That's all it is.
Live where you want, when you want.
Exactly. On their terms. On their terms. And yet they own rental properties, because what they understand is the genius. They're like, man, if I have 10 or 15 good rental properties, not only is my home taken care of, I have a bunch of cash flow on top of that, right? So the mindset is a little bit different, is what you're saying.
Absolutely, and the mindset, and getting to the rental properties, owning 1 or 2 rental properties is very less productive than owning. So there's this study that was out. It was about rental investors, and you get a lot of people that get up to 4 or 5, and they either get to 13 or
they get stuck.
They get stuck, and what happens is you own 4 or 5 properties. You could have 4 or 5 that are in a dire situation at once: renter issues, repair issues, things like that. You get up above 10, you're rarely going to have all 10 that are having issues, and so and I know you teach that a lot. That's the goal, is to get up to that number, so then you can actually start talking about more of a passive investment. When you own 4 or 5, it's not a passive investment, even if you haven't professionally managed.
No, it's called, it's like when you have 1, it's your home. When you have 2, it's called a pain in the ass. When you have 3, it's a bigger pain in the ass. But once you start figuring out a little bit of scale, what starts happening is, and again, these are things that you learn as you build. Right? Yep. I would have never said this. I remember being at 10, 15 properties, and I was like, oh my God, there's checks sitting in the drawer, which I never deposited because it was mismanagement. Nothing to do with the tenants, but it was mismanagement. And today, with a portfolio for 200 plus properties, I never even look at what's happening, because we have a team that just takes care of doing that. But you have to grow to that, right?
And you can start then diving into efficiencies and really working on those numbers.
So I want to kind of go back a little bit to the conversation we had about the mid-markets, right? And in terms of, because a lot of times people will make statements, right, generalities, say, well, you know, I'm going to be just buying Dallas, right? I'm like, listen, right now for rental properties, why would you buy in Dallas? Because it's hard to find value, man, because you and 10 million other people.
How about San Antonio?
Right. That's my point, is that you have to look at, just because somebody, guys, think about this. If a hill is easy to climb and there's a beautiful view, you're going to have a bajillion people climbing it. Yet, there are a lot of beautiful spots that nobody's going to. Why? Because it's just a little bit, you know, you can't go up in your sandals, right? You actually have to put a little bit of effort in, but yet, the view, that in this case, the returns are a heck of a lot harder. We were talking about places like Louisville, right? The markets which are pretty decent markets, right? But yet they're not very exciting. They're small, beautiful ponds. It's easy. The government, basically the people are cooperative in terms of having people like us come and invest in the community, but yet they have great returns.
They have great returns, and the way I look at it is I look at it compared to a low-cost market to a high-cost market. Chicago is actually considered more of a high-cost market.
It is.
So you're dollar for dollar what you can do. Louisville, Oklahoma City, Tulsa, Huntsville, Alabama, those are all markets where you have, like Huntsville, you've got NASA engineers renting out homes for $1,300 a month that somebody bought for $75,000,
Right.
3-bedroom, 2-bath, brick suburban homes. And so Louisville's similar, where you can buy these lesser expensive homes. You can be maybe the next neighborhood or two over from the high-end neighborhood, and it's still nicer. You have people with great income. I mean, when I look at these markets, for example, sometimes I question why I'm living where I'm living, because I'm spending way more for my cost of living with a lot more issues than to go to one of these low-cost, great markets, open themselves up for business. There's a lot of things thriving, and the investors can go in for, you know, I compare it to Denver. Denver right now, you can get some homes that have decent returns, but they're $1 million plus.
Right.
So your risk outlay is huge. Your return is okay,
Right.
but go to a smaller market where you can invest. And now the data and the information is there, and that's why we're going out to those markets, finding investors who want to sell portfolios, so we can plug in buyers who want to buy them. I mean, right now, we're seeing there's way more buyers.
You know, something
than
cool, man.
properties to sell.
As you're talking, I was just thinking, right? I think what would be cool, we should make a list. And we should drop in when we, you know, kind of do a little bit of editing on this. We should drop in a list of some of the markets that we think are great things. And these are not, this is nothing that's hidden data, guys. The thing is, if you put a little thought into it, the reason I wanted to have Noel here was we were having this discussion, right? I'm like, man, we got to capture this. Right? Because this is something that you have to think about in terms of maturity. If you're in a market like Chicago, I mean, we've done extremely well. We have thousands of investors. If you understand how to work this market, you can do really well. The challenge is this: we're in a big city. You're going to deal with a lot of BS. You're going to deal with a lot of the big city issues.
A lot of friction.
Right, a lot of friction. And you're constantly, I've always felt since 2008 that I started investing, you're always having to go upwind, 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 upwind. Now, it has its advantages because most people will fail in this market. So it gives us strategic advantages. But if now I'm going like, well, why not maybe pick one more market that is a little bit smaller? Literally, we can fly in and out, two-hour, hour and a half flight, in and out, and we can have a second kind of a grouping of homes.
Absolutely.
Right? So what would you say to somebody that watches this, hears this, and says, man, I want to really take my business to the next level, or I want to jump into it? Where do you think they start today?
For me, it's a lot about your mindset, right? Okay. So get away from the fixed mindset of this is how it works and it's always been this way, therefore it's always going to be that way. It's not the way it is. There's a lot of data and information. You provide a ton of knowledge. If you can figure out how to invest in Chicago, you've just invested into one of the hardest markets in the country to invest. I've seen funds come in here when we were out there working with the funds. I never wanted to be the first one in with a fund. If they came to us and said, we want to invest in Chicago, we've got $300 million, I would refer them to somebody else, let them fail, and then they come back around to us after they've learned their lessons. So if you can figure it out here or in any of these larger markets, you can go to a smaller market and actually be very efficient. And so Leveraging data, I mean, for us, shameless plug on our website, you can go in and type in any county in the country. It'll give you gross yields. It'll give you the appreciation rate. It'll give you.
Hold on, give out the website first, man.
It's www.renterswarehouse.com.
So renterswarehouse.com. We'll put it kind of on the video as well. So
yep, and I apologize, not gross yields now, but you can see the appreciation rate, you can see what the jobs have been doing, and if we have portfolios for sale, you'll see them there as we're building that out across the country.
Got it, great. And the best part, it's free.
It's free.
It's free,
absolutely.
Right? So it's not like we don't have Noel here to do a pitch or anything, right? We have him here as a guest, value added. If it's a service you can use, reach out, get professional help, and it'll only help you in the right direction.
And we allow people to upload their properties into our platform. It doesn't go live as a listing. They can use that as a just to see how their portfolio is performing, see how it looks, see if on the back end, if somebody uploads their portfolio and it matches one of our buyers, we'll contact them immediately and say, hey, there you go. Because we have some of these, the institutional funds are still buying, but now there's a whole wave of mid-cap funds that are out there that are investing, and they're aggressive, and they buy in these tertiary markets. They're flexible, and so you see a lot of guys in even Dallas. You see some decent opportunities that might not look good for a smaller investor, but look great for a bigger investor. So we have people uploading their portfolios in there for free, checking it out, and then if they decide that they want to list someday, they press a button and it's done, or they contact us, or we work with them, or we give them advice, and we give a ton of people advice on investing more and buying more and how to do that. So we have a ton of resources for that.
Got it. Makes perfect sense. So I want to, as we wrap this up, I want to wrap it up with the person that is, the 5, 10, 15, 20 property owner look at versus what do these bigger companies look at, right? Because you guys talk about, cap rates, and you guys talk about all this language for a lot of people, right? Your everyday investor, it's kind of confusing for them, right? Yep. Why is there a difference between how the bigger players look at it in the market versus people who have 10, 15, 20 properties? Why is there a difference? You mentioned just recently you had a conversation with somebody, right? A ton of money. Right, and you answered pension money. So explain what that means. When people say it's pension money and it's cheap money, what does that mean?
Well, so it's a cost of capital.
Okay.
I mean, so your cost of capital is going to dictate what you can buy.
Got it.
First and foremost, it's also mindset. So if you're in the mindset that you need to earn cash flow every single month on this property, which you want it to cash flow to a certain level, you need to also be thinking about the long-term growth of that portfolio. You need to look at 5, 10, 15, 20 years down the road, and it always gets really interesting at year 5 when we look at a model. And the bigger investors, they can work at even a loss or a cash flow loss with the appreciation coming in, and they leverage that over and over because they've got some great deals in financing. If you're a small investor, you're looking at the cash flow, but then you've got to look at that long-term growth. So being in a market that has a combination of home price appreciation and rent increase and then that cash flow, you're going to really grow into something that is wealth down the road. And what's great about single-family rentals is you can look down 5 years or a year or whatever and say, here's an underperforming asset, let's move this. Here's an asset that's really grown, I'm gonna parlay that into more. There's a lot. It's so flexible. And so it's really having that long-term look, so understanding your financing.
What you're saying is for bigger investors, right? They're getting money, your retirement fund, if you think about this, what are they looking for? They're looking for 4%, right? They're looking for 4%, but they want 4%. Doesn't matter what happens, they want 4%. What they like is blah. They don't like excitement at all. Right. They don't want very much up, very much down. They want a consistent return. Now, mind you, these companies are not stupid, right? They're investing, they have billions of dollars to invest. They invest based on a threshold of risk and a return, a certain amount of money all over the place, right? Some money is going to be high risk, some money is medium, some money is going to be just blah. And when they come in, and that's why they have the ability to be able to do what they do, which is move markets, right? Buy thousands and thousands of properties. And in fact, I used to think, I'm like, oh, these companies are stupid, man. I don't know.
Same here.
And then what you realize is, listen, the equation that they're looking at, the numbers that they're playing with are at a level that your average person doesn't understand. These are not stupid people. In fact, we're the people who are playing with pennies. They're paying with a huge checkbook, right? But on the investor side, on the day-to-day mom and pop, owning 10 properties, 20 properties, 30 properties, their needs and wants mindset is a little bit different. They're going, hey man, I have 20,000 invested per property. Rest of it is on leverage. Rest of it I basically refied out. And now I'm looking at, I want $200, $300, $400 cash flow every month, right? If
Yes.
1 month the cash flow goes down, they start having they go into a hypertension type of situation, right?
And we have a ton of people who come to us and say, I want to sell. Why? Well, I had to do a new water heater and my property didn't cash flow for 2 months. It's like, whoa, take another look at it.
Yeah, it's a great investment.
Yeah.
See, and this happens to us all the time, right? We'll have people, Ria, like, Andrew, you don't understand. Maybe it doesn't happen to you, but this year was horrible. I'm like, really? It was. What happened? Well, I really didn't make any money. Okay, what does that mean? Well, I have 5 properties and all I made was $3,000. I'm like, okay, so let me understand this. I'm like, what should you make on performance basis? Well, 6,000. Okay. Is this the end of the world? Well, no, but I'm like, what happened last 4 years? Well,
Exactly.
oh, that was great. So I'm like, let me ask you a question. So 1 year you made a little bit less. What is your yield curve over a 5-year period? They're like, oh, that is phenomenal. I'm like, what are you worried about? What do you think? It's going to be peaches and gravy all the time?
Yep.
Right? You got to think about it this way. It's like a car, right? You at some point have to stop at every 300-400 miles and put fuel in it. Right?
Yep.
It's not going to just run
change
forever.
the oil.
Change the oil.
Or fix the tire, replace the tires.
Yeah, that doesn't mean it's a bad car,
No.
it's a bad investment. It just, understand, guys, you have to understand what is realistic, right?
Absolutely.
So, having said that, anything else you want to add? If people have questions about Renters Warehouse, they go to renterswarehouse.com, right? Anybody else they can reach out for help?
You can reach out to me. I will either put you with our local team or
Sure.
something we can help you if someone's wanting to sell a portfolio or something. Then we have a lot of different avenues to go. But you can reach out to me. I'm easy to find. I'm easy to find on LinkedIn. We put a ton of content out. And the other thing I was going to say to what you were saying, it's if you own 5 properties and you're using that cash flow to live off of, it's probably not the best idea.
No.
You need to roll that into a reserve so that when you have issues come up, you can look at the bigger picture and not be short-sighted.
Sure.
That's
no, and I think you made a key point, right? And this is a point we've made, which is that, guys, if you take care of real estate for the first 5 years, real estate will take care of you for the rest of your life, right? And that is, and it was so cool that I said that, right? I mean, this was one thing, one day, it just kind of came up and I realized, I'm like, something? Real estate game, really, if you truly want to build wealth, it's about a little bit of patience for a short amount of time. And guess what? You're set for the rest of your life. Noel, it's been a pleasure, man. Thank you so much.
Absolutely. Thank you.
For being
Really
on the
appreciate
show.
it.
I think a lot of people will enjoy it.